Hey, and welcome to another segment of Real Home Buyer Questions, where we answer real questions from real home buyers. Today's question is actually a good one. This one we actually see a lot, and there's a lot of confusion behind it. So I'm actually really excited to talk about this one. Do lenders require your closing cost money to be seasoned? And we don't mean sazon or adobo. If so, how does the seasoning part work if you are saving up the money? This is great one here. This is a good person. This is a good question. Someone trying to get in front of it. So because of the money laundering and anti-terrorism act laws, lenders, because obviously you saw Scarface, right? Where a lot of people money launder through real estate. It's so easy to launder significant amounts of money. So what the government did was they now implement sourcing of funds, and that is their efforts to show that they follow the money that came into a real estate transaction. Now, because obviously there has to be a point to where they're not going to look further than a set time frame, they have a 2 month seasoning requirement. That's where the term comes from. So what the bank will do is the bank will require that they follow the money. So for instance, if you have down payment and closing costs, now down payment and closing costs is paid at closing, at the closing table. So there's a lot of difference between the term closing costs and down payment. But for the sake of the conversation here, closing costs means any of the money that was related to you buying this house. The lender has to source it. They have to show where it came from. So from the step one, when you're buying a house, and you go under contract, the very first expense that you have is the earnest money deposit, the EMD. That is the good faith deposit that per contract it is agreed upon that you will pay for the sellers to hold on escrow, that if you don't close on time or through any of the contingencies on the contract, the seller keeps your money and thank you for playing. If you do close on the loan, that money is actually contributed, credited towards your closing costs, right? Or your down payment requirement. So that is your first expense. The earnest money is the first money that you pay that has to be sourced. Then you have the appraisal. The appraisal you can pay with a credit card, you can pay with a debit card. It does not really matter. You get a link anyways. You make your payment online. If you pay it from your debit card, they can actually credit their appraisal fee as something that you already paid. If you pay it with a credit card, some lenders have different funky little things. So I just want to be able to put that out there. So because you have to source the earnest money, we just had to deal with the realtor who told the customer to just go ahead and take cash to the real estate company for the earnest money. You cannot source cash. The second other thing is go get a money order. Well, here's the problem. If you go to one of this quick little Amscot and you just give them $500 and get a money order and you don't keep the money order stub or anything, we have no way of sourcing that you exchange $500 for that money order because somebody else could have bought the money order on your behalf. So the best thing to do is wire to the title company or the closing attorney. You can do the straight transfer. You can do a cashier's check or you can do a check. Those honestly, because when you go on a contract, you have usually standard 30 days to close. Any of those transactions would have cleared, and you can clearly source with your bank statement or your bank transaction history that it would show that $500, $1,000, whatever your earnest money deposit was, we can see that that came out, and then we'll verify with the closing attorney that they cash your check, whether the check or the cashier's check or the wire was received. It is a cleaner, better method. If you try to have a family member or a friend on your behalf buy the money order and put it for you because now you cannot source that you bought it with your own money, that is now considered a gift, which means that now that person has to do a gift letter with you as well as also provide sourcing via a bank statement to show that that money came in fact from them. And some of these people that helped you may not be so willing to do so. So if you think that's a pain just on the earnest money, imagine when it comes to the closing costs. So we don't do the coffee can, the mattress money, the safe at the floor in the room, because cash cannot be sourced. Because it can't be sourced, it cannot be used. But here's also a benefit because they're only going to go back 2 months. If you know you're going to buy a house, you want to be able to make sure you got your money saved up. And as long as when you come into the transaction, your two most recent months of bank statements show the money already being there and not the deposit coming in, the lender will not ask, because as far as the lender is concerned, the money was there, going back to the last bank statement you provided them. If you're trying to come to the money after you're under contract, then if it's a gift of funds, then we need to do a gift letter. And the donor that's gifting you the funds can either transfer the money into your account or send the money by wire transfer straight to the closing attorney. And they would only need to provide a gift letter and their most recent bank statement showing that they had the money, that the money came out of their bank account and went to the closing attorney or title company. If in this comment where her question was, his or hers was, if so, how does the seasoning part work if you're saving up the money? If you're saving up the money should be saving up in your bank account. The lender is going to look at your pay stubs plus whatever your balance was, and they'll see your balance accruing. Any large deposits that are coming in that did not come from your pay stubs or your work income, the lender's going to question, where did this money come from? If it came from you selling a vehicle, you need to have a bill of sale, a Kelly Blue Book valuation page type model, and you also need to have the bill of sale. And some lenders will even ask for the copy where you signed the title over to the other person to validate. If you had a garage sale or a yard sale, you need to show proof of the bill of sales, the license permit for the yard sale, garage sale. As you can see, it gets a little tedious because the lender has to make sure they source the money, because it's not that the lender don't want to help you, it's that the government will fine a lender in the millions per incident that they're caught taking money without sourcing. And as much as the lender wants to help you with your $300,000 purchase, they don't want to help you as much as to pay millions of dollars for one little slip up. So they're going to cover their T's. So saving your money is not complicated as long as your checks comes in the bank and you're saving it in the bank. If you're trying to introduce cash that you already have from somewhere, unfortunately, you would have to put that in the bank and then wait till you have the 2 months to have your clean bank statement. So that way, when you present those bank statements, that balance is already existing. If the lender sees your balance was $3,000 and then $7,000 was deposited within the statement, they're going to ask, what was this deposit? And if you explain that it was mattress money, coffee can money, or safe at home money, the problem then gets tangled with how they're going to source it. If you get a gift of funds, like I said, all you got to have is the gift letter, have the donor show proof that they have the money and proof that they sent it to the closing attorney, and that will satisfy that. If you sold something, they're going to want to document with evidence that you sold that particular something to justify what you did to get the money. And that is the importance of the seasoning of funds. It matters. This is why in the pre-qualification process, we ask ahead of time for the bank statements. Reason being is we're looking for any NSFs, overdraft, negative balances, any large deposits, because if we can catch anything early, we can help prepare you. You don't want to go under contract assuming you have all your ducks in a row. Now we have 30 days to close, but there's some approved eligible statuses can get away with just 1 month of bank statement, but there's instances where per the automated approval underwriting system, you'll actually want two. And at that point, if with those 2 months and we need to wait an extra month to season your bank statement, but you only have 30 days to close, you can see where we have now a problem where you could have been proactively ahead of this by having talked to the loan officer in the pre-qualification phase. We would have seen it, we would have spotted, we would have put a game plan together, at least what the seasoning waiting period is, so that you didn't get caught off guard when you already have a 30-day contract but got to wait 2 months for it. So that was a good question. We actually see this a lot in the industry, and not just saving up for the closing costs, but even seasoning of funds as early on as the earnings money deposit. So that was great. I hope this actually answers any questions that relate to any ones that you've been having. If there's any particular question that you would like us to touch on, again, just always leave us a comment and we would love to go ahead and hit that topic. Thank you.